It's said that in order to predict the future, you have to understand the past. So on this episode of Money and Markets, we're taking a look back over 2010. Which trends shaped the U.S. markets last year, and what can they tell us about what to expect in 2011? Nilus Mattive discusses whether the surge in stocks is likely to be repeated this year and how income investors can turn a profit regardless of the answer. Mike Larson takes us for a ride on the roller coaster that was the bond market. And Bryan Rich tells us why the same issue that dominated the currency markets in 2010 may do the same in 2011. Plus, Jen Amos gives us concrete recommendations for staying one step ahead of the market moves based on the picks and pans of all the Weiss research editors. All that and a closing comment from Martin Weiss coming up right now.
From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. We are beginning our review of 2010 with a look at the U.S. stock market, which performed better than many experts expected. And joining us on Skype from his home in Chadds Ford, Pennsylvania, with his thoughts is Nilus Mattive, the editor of the Income Superstars newsletter at Weiss Research. As always, so good to see you, Nilus.
Good to see you, Jamie.
Nilus, first of all, what were the major trends that you saw play out in the stock market last year?
Well, it seemed like investors really regained confidence in the economy and in stocks, especially towards the end of the year. The Dow Industrials ended up about 11% higher. The S&P 500 gained about 13%, and the Nasdaq was up a whopping 17%. So, I attribute the rally somewhat to the Fed's easy money policies, but I also think it's due to a sense of relief that, we made it through the financial crisis and we're all still here.
Now, you focus mainly on dividend-paying stocks. What trends did you see from that particular standpoint?
Well, we definitely saw a big rebound in dividend payments last year versus the previous couple of years. A lot of companies are sitting on big cash, and also because politicians in Washington have sort of alleviated all the concerns about whether or not dividends would be taxed at a higher rate in 2011. So, executives are feeling more confident and also are beneficiaries of these lowered tax rates, and so they're starting to boost payments at a more rapid rate.
Let's talk a little bit more specifically about some of the individual sectors of the market that performed either very well or particularly poorly in 2010.
Well, the best performer, according to the S&P 500, was consumer discretionary stocks, and we also saw a lot of strength from industrials and materials and energy. Companies that are more economically sensitive. On the other hand, healthcare was the worst performing sector, only gaining about 1%, and utilities were also sort of laggards last year. That tells me investors are really getting more aggressive as the stock rally ensued, and they were sort of shunning less cyclical stocks going through the year. Okay,
so knowing all of this then, how does that affect your strategy for 2011, and how would you advise other investors to position themselves?
Well, the fact that healthcare and utilities were both underperformers actually makes them more attractive to me going into 2011, especially because, again, they are somewhat defensive in nature and are also pay good dividends. I'm also heavily in consumer staples, and I tell investors to continue favoring these stocks. I think that they have more upside in 2011 than some of the sectors that have already outperformed strongly.
All right, give me some broader predictions now for what we're likely to see in the stock market in 2011.
Well, I think that 2011, we've obviously had a lot of strong performance already, but I think 2011 can be good to stocks again. I'm not looking for any barn-burning numbers, but I do think we'll see some strength across the board. And I cite a lot of reasons, particularly the presidential cycles, which argue for the third year of a president's term being the best for U.S. shares.
All right. Thank you, Nilus. And, of course, we're going to bring you back a little bit later in the show for a roundtable discussion with Mike Larson and Bryan Rich. We'll see you then.
Thanks, Jamie.
Stocks performed well in 2010, but some of the most dramatic moves came from the bond markets. Mike Larson is here to discuss that asset class and how well it performed in 2011. He, of course, is a financial and interest rate specialist at Weiss Research, as well as the editor of the Safe Money Report. Hello, Mike.
Hi, Jamie.
Mike, I want to start with Treasuries. It got a lot of attention last year, as you well know. What were the major trends that we saw in that particular market?
Well, we had a very large rally in Treasuries, up in price, down in yield early in the year as sort of the fear of this double-dip recession scenario. But then during the second second half of the year, we saw an almost equally big collapse in the bonds because the economic data was firming, the inflation fears were rekindling, and also you had this sovereign debt crisis in Europe that's been festering out there and is making investors less willing to buy up government debt, including our own. So now you have this trend where treasuries are falling in price and yields are moving up somewhat dramatically.
The other big story in bonds last year was the collapse of the municipal market. What is your take now on munis?
Sure. Well, Jamie, in addition to just the upward pressure on muni yields from rising treasury yields, I mean, those are the benchmarks for all debt markets, you have a lot of concerns about the credit quality of these states and localities that are selling muni bonds. You look at, in Europe, you've got Greece, Ireland, Portugal that are sort of the canaries in the coal mine for the broader bond collapse. Well, here, the equivalent's California, Illinois, New Jersey, all these other states that have the same kinds of budgetary problems that the European pigs countries do. So investors were selling munis even more aggressively than they were selling treasuries because they're concerned about the credit quality. Are these states going to have enough, tax money coming in to pay for all the promises they've made, especially on the pension front?
Okay. Now, municipal bonds, they've often, they've fallen in concert with treasuries, but they've been getting a lot more velocity on the downside.
Yeah, that's right.
What about the trends in corporate bonds now? What are you seeing there?
Sure. Well, corporate bonds, especially the high yield or junk bond sector, that really tends to track the stock market as opposed to treasuries. It's really a perception of credit quality. If stocks are going up, you may want to own riskier corporate bonds. So that part of the bond market has been doing better than the treasury market and the muni market. But let's call them high-grade credit quality corporates. Those are performing more in line with treasuries, so the same pressures that were impacting treasuries are impacting those. Falling prices, rising yields, and that trend I think is going to continue as we head into 2011.
Okay. Let's talk a little bit now about a general breakdown of how investors should be looking at the bond markets right now. What would be your big picture here, especially heading into 2011?
Sure. Well, if you go by kind of the asset classes that we've talked about, I really don't like treasuries, municipals, or even long-term high-yield bonds as longer-term investments. Higher-grade corporates, I'm not as concerned about the credit quality, but even there, I want to focus on shorter-term durations, a few months, 1 year, 2 year versus, say, 10-year or 30-year debt. I think that the longer-term part of the bond market is going to get hit, again, with prices down and yields rising. You can maybe do some flip trades or some shorter-term trades in municipals and things like that when they really get sold off hard, but that's about it. It's more playing around there. The investment money, the longer-term money, I don't think it is worth investing there. And finally, I think that if you are looking for opportunity where both the credit quality is better, the currency might work in your favor, and the fiscal situation is a lot more sound, I would look overseas. Some of these emerging markets, the governments, again, are in a better shape than the so-called developed markets are. They don't have the same problems that the pigs nations have. So you may want to look at individual bonds or mutual funds or ETFs that give you exposure to emerging market debt.
Okay. Mike, stick around. We're going to be bringing you back for a broad discussion on bonds, stocks, and currencies a little bit later in the show.
Sounds good.
One of the fastest moving markets in 2010 was the currency market. The dollar peaked at the height of the European sovereign debt crisis last summer, then collapsed heading into the November elections, then rebounded again. Joining us to discuss those trends and give us his outlook on what to expect this year is Bryan Rich, the editor of the World Currency Trader at Weiss Research. Hello, Bryan. How are you?
Hey, Jamie. Good. How are you?
Good, good. Okay, first of all, I want you to help us break down exactly what we saw in the currency markets last year.
Right. It was really a tale of two halves. The first half, we saw this deterioration in Europe. It was led by Greece, quickly spread to concerns about some other areas of Europe. The monetary union came into question, and the euro fell dramatically. Global sovereign or global risk appetite pulled back in, and the dollar did quite well for the first half on a safe haven bid. The second half was exactly the opposite. Europe came in with a big stabilization plan that cooled off the concerns about Europe for a while, and we saw a bit of a reversal there. And then certainly going into the second round of quantitative easing from the Fed, the dollar was put under a bit more pressure there as well in the second half.
Okay, but as we saw from Ireland and from Spain's problems over the past couple of months, the sovereign debt crisis isn't over. So do you think it will continue to dominate the currency markets in 2011?
I do. I think the problems in Europe are a major theme for global markets. It's already accelerated more in the couple of weeks into the new year. And I think it's going to continue. It's a matter of how quick the decline will be and how rapid the deterioration will be. Certainly, there are a lot of efforts by European and global officials to make sure it's orderly there. But on the other hand, if you look at just simply growth around the world, the U.S. is expected to do quite a bit better than the rest of the developed world. We're looking at growth here, expectations well into the 2% area, some as high as 3%, and the rest of the developed world is closer to 1%. So that bodes well for the dollar. Increased risks in Europe bode well for the dollar, and both bode fairly badly for the euro.
Okay, so how low do you think the euro could go in 2011? Could it actually collapse?
Well, I think technically, if you look at it, we've been in a 2-year downturn in the euro, which projects a move potentially to parity by the end of the year. I think that's certainly possible, depending on how things unfold in Europe. But then again, as I said, I expect they'll want this to be orderly, and they'll continue to step in to make sure that we don't have extreme volatility in the euro, the second biggest or most widely held currency in the world. So a dramatic fallout in Europe is a big problem for global financial markets and the global financial system.
All right, let's move a continent over. Different continent, totally different story. What are your thoughts on the Asian currencies in 2011, especially the Chinese yuan?
Right. This has been a big theme for years now. And we saw spurts of inflamed tensions with China last year regarding their currency. It continues to be really the primary focus of the G20 to get China to move on their currency. They made a very slight concession last year. And a lot of people think that they're going to accelerate the appreciation of the yuan this year, given the inflation problems China's running into. It would help in curbing some of those inflation pressures there. I don't think they're going to do it. I think they continue to want to hold on to their key export business there. That's underpinning growth in the Chinese economy. It's helping to employ the people of China, and it's anything that would threaten jobs in China and growth in China would be a big problem for the Chinese government, as we could see some more social unrest there.
Okay, one of the biggest stories in the currency markets last year was, of course, Japan's intervention to weaken the yen. That didn't work out so well. What is your outlook for that currency going forward?
Right. So they stepped in late last year, intervened to try to weaken the yen. Did so in a successful way for a short period of time until the yen finally began to strengthen again. But fundamentally, everything points to a higher dollar against the yen. And I think we'll see the Bank of Japan back in this year if the markets don't weaken the yen themselves. And again, if you look back at the G20 statement last year, even given the problems around the world, these currency wars that were a bit of a theme going into it, the G20 really sort of gave Japan a green light to step back in. They said that the advanced economies of the world would continue to essentially step in and intervene to ensure that their currencies aren't competitively undervalued, which isn't the case for Japan. Certainly, it's overvalued, but also to ensure that there's not excessive volatility or disorderly and adverse moves in currencies. So I think we'll see Japan step in if the markets can't turn the tide in dollar yen, given the problems to exporters in Japan and the threats to the economy in Japan. They want a weekend, no doubt about it.
All right. Thank you, Brian.
Thank you.
Brian's going to be back a little bit later in the show, along with Mike Larson and Nilus Mattive, to discuss the broad themes in the U.S. markets last year and how stocks, bonds, and currencies will interact in 2011. First, though, we'll give you concrete recommendations for playing the markets this year based on the trends the Weiss research editors observed in 2010. Jen Amos will be here after the break with this week's Picks and Pans. As always, if you have any questions or comments, just email us at weissmoneynetwork@weissinc.com. We may not be able to respond to all of your emails or address them on air, but we're keeping everything on hand for future episodes. And as always, we appreciate the feedback. Money and Markets will be back